22 months. That's how long it took the S&P 500 to recover from the pandemic crash from March 2020 and reach a record high in January. Only the last 4 months have seen a general decline, particularly with the Nasdaq as we're entering correction territory. Notice I'm not using the word crash. I don't need a catchy thumbnail to pull in views, and I think what we're seeing is a long time coming. Think of it this way: would you be worried about a speed camera if you were driving within the speed limits? When I covered the yield curve, I said I would start a series of videos outlining my investment strategy and the concepts I use to pick stocks. Over the last week, which can only be described as a mess, I'm going to start with a couple of analogies that I think will be of help. Here we go. There are three types of people when it comes to the stock market. The bulls who continue to think stocks are cheap and more rallies are around the corner, so they act like Wall Street puppets, and then we have the bears who think we're in a bubble and the mother of all crashes, a collapse of mega proportions, an extinction level catastrophic event that is going to hit Wall Street like a tidal wave of destruction, send us back to the ice ages, and we'll be seeing the four horsemen of the apocalypse before it ever recovers. Then there are the more conservative thinkers who think a correction is necessary to offset the previous rallies and bring stocks down to more sensible levels. I think all three lines of thought are applicable to the market, and it just depends on what stocks you're buying. To explain this, the fundamental question is, are stocks cheap? Well, what exactly defines cheap? Well, the price to earnings ratio is the bread and butter of stock selection for many investors, and the lower this is, the more value and growth a stock should present. The difficulty is understanding that the PE ratio is dependent on an industry and the level of expected growth for a company, which can change, and investors may take a different stance depending on their level of industrial knowledge. That's why more technically minded investors would review other metrics in their stock selection. The price to earnings growth ratio is a good one, where a score below 1 is typically considered to be undervalued, but the PEG ratio is awkward to calculate as it requires knowledge of the industry or decent analyst coverage. So that leaves us with some more basic metrics such as the price to sales, price to book, and an enterprise value to EBITDA ratio. The benefit of understanding these scores is that if a stock is treated rationally, these scores should remain the same. Price to earnings ratio, for example, should reflect a stock that grows as the company grows in earnings and therefore stay the same. That means that for these metrics to come down, either the company outperforms or the stock becomes lower in value. But let's assume that these are good scores to help investors find stocks, and for my example, I've picked some of the largest cap companies that have had the best runs and largest influence on the market over the last 2 years. I've gathered data on the historic metrics, so let's start with Apple as an example. If we go back as far as 2012, the company traded at some pretty low metrics: 12 times earnings, 3 times sales, and just short of 4 times book value, and a PEG ratio of 0.48. Hindsight would tell you how accurately that number reflected the company's potential for growth, and it's fair to say the stock was going cheap at the time. But as you can see, over the last 10 years, as the stock has rallied, these scores have also risen, and they've been boosted further during the pandemic in 2020. At its peak at the end of 2021, it could be argued that at its current metrics, it's no longer cheap. It's been pushed to peak value, and from what we've seen this year so far, the stock is in correction territory. Now, if I bring in data for some more of these hyped up companies, we can see Tesla sticks out like a sore thumb, hitting a shocking 1,341 times earnings ratio in 2020. Fortunately for Tesla, they improved on earnings and brought this figure down. In fact, if we were to just count the last 2 years as the market recovered and rallied, Tesla shows almost a straight line down, and if we remove them to scale up the others, we have pretty much the same pattern. If we move across price to sales, we see a similar pattern. The ratios peaked in 2020 and 2021, but we're now seeing a correction. Again, if we look at the price to book values, the same pattern. For enterprise value to EBITDA, Facebook really shows how much it was peaked, and the sudden drop to current range clearly represents the massive drop the stock took on its past earnings, down 39.82% in the last 6 months. Take them away, and we're seeing that pattern again with the others. What we're seeing here is that when company metrics reach these sort of peaks, it's not sustainable, and either the company needs to improve on earnings or investors are going to sell to bring the metrics back into more reasonable levels. Now, if we take the sum of all these metrics as a guide, we're seeing the same pattern across all these stocks, and if I total all these together to represent the group as a whole, we have a clear pattern where 2020 and 2021 peaked, and 2022 is correction territory. So when it comes to whether stocks are cheap, it just depends what you're looking at. These particular companies have clearly peaked far above their value ratios from previous years, and they're more likely to continue in correction territory. So no, they are not cheap. And that's without going the various hyped up stocks, Roblox, Coinbase, Unity, Peloton, or pretty much anything that Cathie Wood has been buying. Non-profitable, high fundamental stocks that were asking for a sell-off.
Emotional, damn it!
So that's why when you see huge volatility on the markets, with the Dow shooting up 932 points on Wednesday, then falling 1,063 points on Thursday, 1,162 if you include Friday as well, we are seeing a correction, a reshuffling of investments, with the most expensive stocks being sold as investors look for safer and better valued options. Let's take this data analysis and apply it to a stock I covered in my last video, Qualcomm. If we look at the annual metrics of the last 10 years, there have been some highs and lows, essentially corrections throughout this period. 2018 specifically was a tough year for the company when they were impacted by the US-Chinese trade war, which led them to terminating the acquisition of NXP and refocusing their business towards diversification, including a new focus on automotive technologies. This reset, if we call it, brought the company's metrics down to more reasonable levels, and they're currently trading with an EV to EBITDA rating of 10.74. That's 6.36% less than it did 10 years ago. The PEG ratio is down to 0.69, 37.84% less, and this alone states the company is undervalued. The price to book value is at its lowest in 4 years, and the basics such as price to earnings trades at 22% less and price to sales at 23% less. So when we look at the stock price that has grown considerably over the same decade, a dividend that has been consistently increasing in value for shareholders, and financials that show that the company is generally performing better today than it was 10 years ago, we have a stock that is effectively cheaper today than it was then. So the point is that company stocks can get out of hand and become more expensive, but eventually the market catches up with itself and a correction occurs, bringing these companies back down to fairer levels, and Qualcomm shows just how this volatility can create opportunities to buy good companies at better prices. To top this off, I want to reiterate the story of Bob the investor, the worst investor in history. Bob started trading in 1970 at age 22 by saving $2,000 a year, increasing to $4,000 in the 80s, $6,000 in the 90s, then $8,000 a year until he retires at the age of 65. Unfortunately, Bob is not a good investor. He doesn't do much research and he only invests his savings into the S&P 500 whilst it's having a bull run, and his investments were often followed with a downturn year. So, starting with his initial $8,000 investment in 1972, right at the bull market peak, he saw it fall during the 1973 to 1974 bear market crash, where he lost 42% of value. Still, he followed this routine, investing all his savings during a bull run, but he never sold, so he was holding on during the 1987 crash, the 2000 dot-com bubble crash, and the 2008 housing market crash, which saw the S&P 500 fall a massive 38.49%. Despite this bad luck, he never sold, and he stuck to his routine. The result is that after investing a total of $196,000 at the worst possible times, he retired in 2013 with a portfolio valued over $1 million. He walked away with a return of over 515%. Now, if we introduce Rich, an investor who followed exactly the same saving strategy as Bob, but he only invested after every downturn year, effectively investing later than Bob each time, his portfolio would be worth $129,000 or 12.8% less. Despite Bob having the worst timing ever, his perseverance and reluctance to sell eventually paid off, and it was his time in the market, not time in the market, that enabled Bob to outperform Rich. So when the market is screaming correction territory, and I know it can be especially trying when your investments are taking a hit, just remember Bob. If you're prepared to buy and hold stocks when they're at their lows, then the payoff can be larger in the long run. But the real trick is being able to identify which stocks are offering the best value at the opportune time, and that's what I try to do with my channel. Markets need corrections, and they occur a lot more regularly than people think. I've always been critical of how the media can focus on the same companies, and their influence with investors can drive stocks up to ridiculous valuations. Factor in the range of trading applications on offer to retail investors, then trading fund managers pushing speculative funds with false promises, and it's no wonder the market has been driven up to such ridiculous levels. This isn't helped by CEOs themselves being able to influence the market through something as simple as a tweet, or the introduction of various meme trading tactics, Wall Street bets, or how about NFTs? Any takers? The market eventually catches up, and the volatility we've been seeing lately is where investors are rethinking their exposure to some of the biggest companies on the market trading at high fundamentals, which are not only seeing the largest drops in values, but influencing investor sentiment towards the market as a whole, meaning better valued companies are being thrown out with the bathwater. It's for that reason that investors need to know how to truly value a company and not get caught up in the hype, and instead be looking for better opportunities to invest. And despite what the media says, investing in these hyped up large cap companies as they dip is not the best strategy for times like these. It's like playing a game of hot potato, and I think it's better to pass them on in favour of companies trading at far better valuations and offer greater growth potential. These companies exist, you just have to have the discipline and be willing to do the work to find them. So that's my take, and if you have any thoughts or questions, please comment below, let me know, and if you like what you see and you want to see more, please remember to smash that like button and subscribe so you don't miss out on future videos. Until next time.